Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio and cut right through all that market weakness. All right, today we are putting on the hard hats. We're grabbing the blueprints because we are about to stress test the structural integrity of a fallen giant, Kraft Heinz. After a bombshell earnings report sent some serious shockwaves through the market, the really big question is this. Is this iconic company in the middle of a multi-billion-dollar rebuild, or is it just headed for total ruin?
So before the opening bell even rang, the market delivered its verdict. And let me tell you, it was absolutely brutal. A 6.71% drop in pre-market trading. Now you got to understand, this isn't some gentle correction. It's not a slight dip. No. This is the market delivering a swift, merciless judgment on the company's Q4 performance and maybe more importantly, its entire outlook for the future. When you see a drop this big before the market even opens, that signifies a massive, institutional-level flight for the exits. The big money, the sellers, they showed up in force, and believe me, they weren't taking any prisoners. This is the market screaming at the top of its lungs that something is fundamentally, deeply wrong with the structure.
And really, that's the core question we have to wrestle with today, isn't it? Is this insane drop just a crack in the foundation that the new CEO, Steve Cahillane, says is fixable? Or is this a sign of something much worse, a fundamental collapse, a house of cards just teetering on the brink of total ruin? You see, on one hand, you've got the management team out there telling investors, hey, we've got the tools, we've got the plan, we're going to repair the damage. But on the other hand, you have the market voting with its dollars, and it is screaming that the structure is completely unsound. So our job is to figure out if this is just management hype or if there's a real, tangible path to recovery here.
To figure that out, we've drafted our own blueprint for this deep dive. It's going to go like this. First, we'll dig into the market's guilty verdict and really assess the immediate damage report. Second, we're going to put the core numbers from that earnings call under some intense pressure. We're going to see if they buckle. Third, we'll examine the new CEO's blueprint for this multi-billion-dollar rebuild. Fourth, we are absolutely going to analyze their sudden and frankly controversial strategic U-turn on splitting the company. And then finally, we will deliver our verdict. Is Kraft Heinz a generational buying opportunity, or is it a classic textbook value trap?
Okay, so let's start with the immediate damage report. I mean, before we can even begin to think about a rebuild, we have to understand the full extent of the wreckage. The market has delivered its opening statement, and it has been nothing short of brutal. Analyzing this initial reaction is so critical because it reveals just how deep the investor's skepticism runs, and that's the mountain that this company's new strategy has to climb.
Just look at these numbers. The pre-market price, sitting at $23.23, is hovering dangerously close to its 52-week low of basically $22. We're talking about a massive, breathtaking destruction of shareholder value over the last year. This isn't just one bad day, you see. This is the culmination of a truly disastrous year that has seen investor confidence just completely evaporate. For anyone who's been holding this for the long term, this is agonizing. And for any potential new investors, well, it raises that terrifying question of whether you're about to try and catch a falling knife. The stock has been absolutely hammered, and this latest drop just digs that crater even deeper.
And this isn't just panicked retail investors hitting the sell button in their pajamas. No. What's really telling on this slide is the professional consensus. Get this. Out of 22 Wall Street analysts covering the stock, a staggering 17 of them are telling their clients to just hold. 4 have an outright sell rating, and there's just one single lone wolf analyst out there who sees a strong buy. Let me be crystal clear. A hold rating from this many professionals is not a neutral position. It is a vote of no confidence. It means they see absolutely no compelling reason to buy the stock, and they're advising their clients to stay on the sidelines. The consensus rating is reduce. That tells you everything you need to know. There is a deep structural lack of faith from the very people who analyze this company for a living. They've inspected the foundation, and they are advising extreme caution.
All right, we've seen the market's brutal reaction. Now it's time to roll up our sleeves, get into the engine room, and run our own diagnostics. We need to move past all the noise and the panic and stress test the actual financials from that earnings call. Because at the end of the day, these are the numbers that will determine whether this whole structure stands or if it comes crashing down.
So in every structure, you always look for the strongest support beams, right? For Kraft Heinz, that one beam was their earnings per share. They reported an adjusted EPS of 67 cents, and that soundly beat the forecast of 61 cents. That's a nearly 10% positive surprise. Now, this does demonstrate a core competency. They know how to manage expenses and control costs effectively. They can squeeze more profit out of every single dollar of sales. In a shaky building, this is one solid steel beam that they can point to. It shows management discipline, and that is an absolutely crucial trait during a turnaround.
Yeah, but that strong EPS beat, it's holding up a rotting floor.
Honestly, it feels like a distraction from the one thing that really matters. You cannot cut your way to growth. Revenue is the absolute foundation of any business, period. And this slide says it all. Their foundation is shrinking. They missed revenue expectations, sure. But the truly alarming number is that 4.2% drop in organic net sales. See, for a consumer goods company, organic sales are the purest measure of health. It means fewer people are walking into stores and buying their products. This isn't some minor crack in the wall. That's a chasm opening up in their core business. It signals a major loss of market share and relevance with the modern consumer.
And this right here, this chart, this illustrates the real story. If you thought that sales decline was bad, their guidance for the future signals a complete and total structural failure in profitability. Full year 2025 adjusted EPS already dropped a painful 15%. But just look ahead. For 2026, they're guiding to a range of just $1.98 to $2.10 per share. That is a catastrophic collapse. Institutional investors, the big funds, they build their models on forward guidance. And a forecast this grim is an immediate, flashing red flag. The market isn't just reacting to one bad quarter. It's reacting to a multi-year forecast that signals deep, systemic problems are expected to get worse before they get better, if they get better at all.
However, and this is a big however, the bull case points directly to the company's primary weapon, its most powerful tool for this entire rebuild, $3.7 billion. That is their free cash flow for 2025, which is a stunning 16% increase from the prior year. This, right here, this is the company's war chest. It's the mountain of high-grade steel and concrete they absolutely need to fund a complete overhaul. Cash flow provides options, it provides power, and it gives them the raw materials to execute a massive turnaround. With $3.7 billion, they can fund their new investment plan, they can pay down debt, they can buy back shares, and they can weather the storm while they retool the business.
But the critical question, the one we have to ask, is whether all this cash is just a tool to bail water. I mean, the facts on this slide suggest the ship is taking on water from multiple breaches at once. North American retail, their biggest and most important segment, saw organic sales sink by a staggering 5.2%. This is their heartland, and it is shrinking fast. The global away-from-home business, we're talking restaurants, food service, that dropped 1.5%. Look, these are not small leaks. These are core segments that are actively sinking. That $3.7 billion in cash might just be delaying the inevitable if they can't plug the holes where the money's actually made. Which brings us directly to the new CEO's plan. See, he's not just proposing to patch the holes, he's laying out a detailed blueprint for a complete reconstruction. This is a $600 million gamble, and it's designed to shore up the company's crumbling walls and forge a new, stronger path forward. You have to see it for what it is, a bold admission that the old structure has failed and that a massive injection of capital is the only way forward.
So where is all this money going? Well, this isn't a blind bet. It's a very calculated two-pronged assault on their biggest weaknesses. Half of that $600 million goes directly to price, product, and packaging. This is a direct attack on their value proposition, an acknowledgement that they've really lost touch with the consumer on both quality and cost. The other half is earmarked for sales, R&D, and marketing, basically rebuilding their atrophied ability to innovate and actually execute in the marketplace. It's a very balanced approach, trying to fix both the product itself and the engine that's supposed to sell it.
And this capital injection is guided by a really clear four-step strategy laid out by CEO Steve Cahillane. Number 1, contemporize brands. That means updating tired packaging and old messaging. 2, differentiate products, creating new variations to appeal to modern tastes. 3, strengthen the value proposition, competing more effectively with all those store brands. And 4, improve commercial execution, which is a fancy way of saying just getting better at sales and marketing. This isn't just a list of corporate buzzwords. This is a direct diagnosis of the company's long-term illness. A decade of underinvestment that allowed their most iconic brands to basically rust. And you have to listen to the CEO's own words here. He's not out there blaming the economy or the consumer or the competition. He is saying the problems are internal, they are known, and, this is the key part, they are within the company's control to fix. For an investor, hearing a leader take that level of ownership is an incredibly powerful signal. A CEO who makes excuses is a huge red flag. A CEO who takes responsibility and presents a clear plan, well, that provides a reason for confidence. He believes these are not fatal cracks but repairable issues, and he is putting his reputation on the line to prove it.
But let's be real.
Confidence is cheap, and repairs cost real money. The fear that is nagging every single investor is right here on the screen. Are they just pouring $600 million of fresh concrete into a sinkhole? The plan sounds good, sure, but what if the ground underneath, the brands themselves, is fundamentally unstable? What if consumers have simply moved on from Lunchables, Kraft Singles, and Oscar Mayer hot dogs in favor of healthier, fresher, private label alternatives? That is the absolute core risk. This entire investment could just disappear without a trace if the brands themselves are truly antiquated.
Now, this new strategy is complicated by the elephant in the room, the company's sudden screeching U-turn on its plan to split itself into two. Just months ago, a breakup to unlock value was the strategic path forward. Now, it's on an indefinite pause. This raises some very serious questions about the stability and conviction of the leadership's long-term vision. It looks reactive, not strategic, and let me tell you, the market absolutely hates that kind of uncertainty.
However, let's put this move into context for a second. Kraft Heinz isn't the first company to pull the emergency brake on a major corporate split. Just look at this list. DuPont, Bayer, Gap. These are major blue-chip corporations that reversed course when market conditions became too volatile. So you can argue this isn't a sign of weakness, but a sign of pragmatism. When a hurricane is approaching, you don't start a major renovation. You board up the windows and you focus every single resource you have on reinforcing the core structure against the coming storm.
The strategic term for this is optionality. By pausing the split, Kraft Heinz is preserving the right, but not the obligation, to make that move in the future. The goal is to execute this turnaround first. They want to be in a position where they are separating two healthy, growing businesses from a position of strength, rather than being forced to jettison a struggling unit out of a position of weakness. At its core, it's about controlling their own destiny and making a crucial strategic move at the time of their choosing, not when their hand is forced by a panicked market.
Okay, we've stress-tested the numbers, we've inspected the blueprint for the rebuild, and we've debated this whole strategic U-turn. It is now time to weigh all the evidence and deliver the final iron financial verdict. Is Kraft Heinz a solid turnaround opportunity that's under construction, or is it a dangerous, dangerous value trap just waiting for the next tremor to cause a total collapse?
All right, let's break it down. The bull case for this rebuild rests on the solid foundation of that massive $3.7 billion in free cash flow. That gives them the firepower for a real fight. You have a new CEO with a clear, fully funded $600 million plan who confidently states the problems are fixable, and by pausing the split, they are focusing every single resource on this one mission. But the bear case? Man, the bear case is a 5-alarm fire. Organic sales are in a 4.2% free fall. The 2026 EPS guidance is frankly grim. There's immense execution risk in a plan this ambitious, and it could all be for nothing if the bears are right and the company's core brands are simply antiquated relics of a bygone era.
So here it is, the iron financial verdict. First things first, this is not a quick fix. This is a multi-year, heavy-lifting construction project that will seriously test investor patience. Second, that $3.7 billion in cash flow provides the raw materials, but the new blueprint is completely unproven and the construction crew is brand new. Third, those declining sales and that dire earnings guidance, those aren't just hairline fractures. They are deep structural cracks in the foundation that you absolutely cannot ignore. Fourth, the risk of this being a classic value trap is exceptionally high until the company can prove it can generate real, tangible, volume-led growth. And I mean growth from selling more stuff, not just from price hikes. And finally, the first true stress test for this new plan will be the market share data that comes out in the second half of 2026. Until then, this remains a very high-risk gamble on a deeply flawed structure.
So we'll leave you with one final question to consider for your own portfolio. This company is embarking on a period of intense, heavy lifting with a very, very uncertain outcome. Before even thinking about an investment here, you have to ask yourself a serious question. Is your portfolio strong enough to handle the immense weight of Kraft Heinz? This is a turnaround story that could easily crush an investor long before it ever sees the light of day. Proceed with extreme caution. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.